This question tests your understanding of static budgets versus flexible budgets and their appropriate use for planning and performance reporting. Sugar Corporation's monthly sales volume fluctuates significantly, ranging from 7,000 to 9,800 units. When activity levels vary, managers need a budgeting system that adjusts costs to different levels of output. A flexible budget is designed for this purpose because it expresses variable costs per unit and recalculates total budgeted costs based on the actual activity level. This makes it valuable both for planning future resource requirements and for evaluating actual performance. In contrast, a static budget is prepared for only one level of activity and does not adjust when sales volume changes. Comparing actual costs with a static budget may produce misleading variances caused simply by changes in volume rather than operational efficiency. The key concept is that when activity is expected to fluctuate, flexible budgeting provides more realistic planning information and more meaningful performance evaluation. A. Planning. Static performance reporting. Static. Incorrect. A static budget is unsuitable when sales volume varies significantly because it cannot adjust to changing activity levels. B. Planning. Static performance reporting. Flexible. Incorrect. Although a flexible budget is better for performance reporting, planning under variable activity should also use a flexible budget to estimate resource needs accurately. C. Planning. Flexible performance reporting. Static. Incorrect. Flexible budgeting is useful for planning, but using a static budget for performance reporting would produce distorted variance analysis. D. Planning. Flexible performance reporting. Flexible. Correct. A flexible budget should be used for planning, since selling expenses and cash needs change with sales volume, and for performance reporting, because it adjusts budgeted costs to the actual level of activity, allowing meaningful comparisons with actual expenditures. Correct answer. D. Flexible for planning and flexible for performance reporting. Flexible budgets provide superior planning and control whenever business activity is expected to fluctuate, making them the preferred tool for both budgeting and performance evaluation. This question tests your understanding of variance analysis and the relationships among different variances in a flexible budget and standard costing system. A key objective of variance analysis is not only to identify differences between actual and standard costs, but also to understand how one variance may influence another. Students should recall the major variances. Material price variance arises from paying a different price than the standard price. Material usage, quantity, variance results from using more or fewer materials than expected. Labor rate variance reflects paying workers a different wage rate than standard. Labor efficiency variance measures whether more or fewer labor hours were used than standard. Variable overhead efficiency variance is typically based on actual labor hours, so it is directly affected by labor efficiency. Fixed overhead volume. Variance depends on production volume rather than labor efficiency. The question asks which pair of variances is most likely to be related. Students should identify variances that share the same activity driver or are commonly influenced by the same operational factors. A material price variance and variable overhead efficiency variance. Incorrect. Material prices and labor hour-based overhead efficiency generally have little direct relationship. B. Labor rate variance and variable overhead efficiency variance. Incorrect. Variable overhead efficiency depends on labor hours used, not the wage rate paid. C. Material usage variance and labor efficiency variance. Correct. Excessive material waste often requires additional handling and rework, increasing labor hours. Likewise, inefficient labor can lead to greater material waste. Therefore, these two variances are frequently related through production efficiency. D. Labor efficiency variance and fixed overhead volume variance. Incorrect. Fixed overhead volume variance is driven by differences between actual and budgeted production volume, not labor efficiency. Correct answer: C. Material usage variance and labor efficiency variance. These two variances often move together because inefficient labor can increase material waste, and excessive material waste can require additional labor time, making them closely related in manufacturing operations. This question examines the advantages of a flexible budget compared with a static budget, a fundamental concept in management accounting and performance evaluation. A static budget is prepared for a single planned level of activity and remains unchanged regardless of actual production or sales volume. In contrast, a flexible budget adjusts revenues and variable costs to the actual level of activity, while fixed costs remain constant within the relevant range. The main purpose of a flexible budget is to provide a fair and meaningful comparison between budgeted and actual performance. If actual output differs from the original plan, comparing actual costs with a static budget may produce misleading variances caused simply by changes in activity levels. A flexible budget eliminates this problem by recalculating expected costs for the actual volume achieved. Therefore, managers can evaluate whether costs were controlled efficiently rather than whether activity levels changed. The key concept is that flexible budgets improve performance evaluation by comparing costs at the same activity level. Shortfalls in planned production are clearly presented. Incorrect. A flexible budget adjusts to actual activity rather than highlighting production shortfalls. B. Standards can easily be changed to adjust to changing circumstances. Incorrect. Standard costs are normally established separately and are not automatically changed through flexible budgeting. C. Fixed cost variances are more clearly presented. Incorrect. Flexible budgeting primarily improves the analysis of variable costs by adjusting for activity levels. It does not specifically make fixed cost variances clearer. D. Budgeted costs for a given output level can be compared with actual costs for the same level of output. Correct. This is the principal advantage of a flexible budget. It adjusts budgeted costs to the actual level of production or sales, allowing managers to compare like with like and identify true operational variances. Correct answer: D. Budgeted costs for a given output level can be compared with actual costs for the same level of output. Flexible budgets provide a more accurate basis for cost control and performance evaluation because they eliminate the distortion caused by differences between planned and actual activity levels.